In this module, we'll introduce the concept of no arbitrage and work through a very simple example of the application of the no arbitrage principle to pricing. Consider a contract that pays CK dollars at time t equal to k, where k takes values 1, 2, 3 up to capital T. And let's say that one has to pay a price P at time t equal to 0 in order to receive this contract, in order to get this cash flow. So the story is, here's time t equal to 0, where you pay a price P, here's time t is equal to 1, and all the way up to time t equal to capital T, and you get cash flows C1, C2, and so on up to C capital T. And the goal of this module is to introduce ideas of no arbitrage that allow us to fix this price P. It will turn out that in certain circumstances we would be able to fix this price exactly, and in certain other circumstances we can only be able to bound the price. We can tell you the price cannot be larger than a certain quantity and cannot be smaller than a certain quantity. There are two ideas of arbitrage that are used in financial engineering. One idea is called weak no arbitrage, and the second idea is called strong no arbitrage. Both of these ideas essentially eliminate the possibility of a free lunch. Let's first consider weak no arbitrage. What this condition says is, suppose there is a contract such that the cash flows associated with this contract are non-negative for all times k greater than or equal to 1. C1, C2, C3, and so on up through C capital T are all greater than or equal to 0. If there is such a contract, then the price for this contract must be greater than or equal to 0. The strong no arbitrage condition says that suppose there is a contract for which the cash flows are non-negative for all times in the future, and there exists some time CL in the future such that the cash flow is strictly positive, then the price for such a contract must be strictly positive. Both of these conditions are motivated by the fact that in a market, if there are contracts for which you get something for nothing, then just by supply and demand, that contract will be priced to a point where you'll have to pay a fair price. Let's walk through the rationale for the weak no arbitrage condition. Suppose there exists a contract for which CK is greater than or equal to 0. That means you get non-negative cash flows for all times in the future, but the price for such a contract is less than 0. So weak no arbitrage says the price must be greater than or equal to 0. Here I'm assuming that the price is less than 0, and let's see what happens. Since CK is greater than or equal to 0, you do not owe anything in the future, and the buyer of such a contract receives minus P, because P is less than 0, which means you have to pay a negative amount to receive it, which is the same thing as saying you receive a positive amount at time t equal to 0. The buyer never loses any, and at the same time gets money at time t equal to 0. This is a free lunch. Weak no arbitrage condition says this cannot happen. Why can't this happen? This cannot happen because if there is such a contract, such that P is less than 0, then the seller of such a contract will start increasing the price. It's a bad deal for the seller. The seller will keep increasing the price. But for any price P less than 0, this is a very good deal for the buyer. So the buyers are still going to be there. And this price, the seller would keep increasing the price until P hits equal to 0. At least. She might be able to increase the price to be something greater than 0, but the weak no arbitrage condition doesn't allow us to figure out how exactly this price is going to work once the price becomes greater than 0. We can only say, using the weak no arbitrage condition, that the price will be increased until P becomes greater than or equal to 0. You can make the same argument from the buyer's perspective. Since it is a good deal for any price less than 0, the buyers will be willing to pay a higher price in order to compete. They will compete with each other until the speed less than 0 cannot be sustained in the market. Recall, in the other module, I talked about the fact that how prices get set by supply and demand. You again see here that the rationale for weak no arbitrage is built on supply and demand. We are building it on the fact that there are many buyers, many sellers. We are also using the fact that the information about the details of the contract are publicly available, are uniformly available to buyers and sellers. This is going to be important, and we'll emphasize this again on the next slide. Here, I'm going to work through the rationale for a strong no arbitrage condition. Suppose P is less than or equal to 0. Strong no arbitrage condition says that P must be strictly greater than 0 for a contract for which the future cash flows are greater than or equal to 0, and there exists some time where the cash flow is strictly positive. Since CL is greater than 0 for some L greater than or equal to 1, even if P is equal to 0, this is a free lunch. It's a free lunch as long as P is less than or equal to 0. Again, using the same arguments that we used before, the seller of such a contract will have an incentive to increase the price. The buyers will still be around because it's still a good deal at something positive. We cannot guarantee what the precise value of the price is going to be, but for some price strictly positive, it will still remain a good deal because there exists a cash flow CL which is strictly positive for some time L in the future. And again, buyers and sellers will compete in order to set the price P. The implicit assumptions that are underlying the no arbitrage conditions are the markets are liquid, which means there are sufficient number of buyers and sellers. If the markets are illiquid, the no arbitrage condition is not valid, and the bounds that we generate using the no arbitrage argument will no longer be valid. We also assume that price information is available to all buyers and sellers. The price information here basically means what are the cash flows. If there are buyers and sellers which are ignorant about the cash flows, then the price formation process will not happen. We also assume that the competition in supply and demand will correct any deviation from the no arbitrage prices. And this again presupposes that there is a market, these markets are liquid, the price information goes to every buyer and every seller so that they can decide how to set the price efficiently. In the rest of this module, I'll just walk you through a very simple example on how to use no arbitrage condition to price a very simple fixed income instrument. In the later modules, we'll go over more complicated examples where you use no arbitrage condition to set prices for more complex derivatives. So consider a very simple bond. What this bond gives you is $8 in 1 year, and we want to set the price for this bond. Suppose in the market, one is able to borrow and lend unlimited amounts at an interest rate R per year. So the bond pays $8 in 1 year. We can borrow and lend unlimited amounts at the interest rate of R per year. And we want to figure out what is a fair price or an arbitrage-free price for a contract that pays $8 in 1 year. We'll do it by constructing two different portfolios. So let's construct the following portfolio. You buy the contract at price P, and you borrow A divided by 1 plus R dollars at an interest rate of R. Consider the cash flows associated with this portfolio. In the future, in 1 year, the contract will pay $8, and you've borrowed A divided by 1 plus R at the interest rate of R, so you have to pay $8. These two cancel each other, so the cash flow in 1 year is A minus A equal to 0, so C1 is equal to 0. And what is the price of this portfolio? The price of this portfolio is P, the amount that you had to pay to get the contract, minus A divided by 1 plus R, because this was the cash flow that you received at time t equal to 0. So the net price that you paid for the portfolio is P minus A over 1 plus R. Now let's use the weak no arbitrage condition. The weak no arbitrage condition says that if the cash flows in the future, and in this particular case there is only one time in which there is a cash flow in the future, in 1 year, if the cash flows in the future are greater than or equal to 0, then the price must be greater than or equal to 0. C1 greater than or equal to 0 implies that the price of the portfolio Z must be greater than or equal to 0. Price Z is equal to P minus A divided by 1 plus R. This must be greater than or equal to 0, which means that P must be greater than or equal to A divided by 1 plus R. So we now get a lower bound for the price. No arbitrage, weak no arbitrage condition gives me a lower bound on the price And we got this lower bound by constructing an appropriate portfolio. Now, in the next slide, we'll get an upper bound for the price by constructing a different portfolio. So construct a portfolio, we sell the contract at price P and lend A divided by 1 plus R at the interest rate R. Now what happens? The cash flow is again 0 in the future because you've lent an amount A divided by 1 plus R at interest rate R. So in 1 year, this returns you a value A. Since you have sold the contract, you're now responsible to pay A dollars to the buyer of the contract in 1 year. These two cash flows cancel each other, and therefore C1 again is greater than or equal to 0. In fact, C1 is equal to 0, which is the same thing as greater than or equal to 0. It satisfies the condition that C1 is greater than or equal to 0. What about the price of this portfolio? The price of the portfolio is how much did you have to pay in order to construct this portfolio. Since you sold the contract at price P, you receive that amount, so that's minus P. Because you had to lend A divided by 1 plus R at the interest rate R, this is the outflow. So A divided by 1 plus R is the total amount that you had to pay. The difference between these two, A divided by 1 plus R minus P, tells you the price of the portfolio. The weak no arbitrage condition tells me that since C1 is greater than or equal to 0, the price that I paid for this contract must also be greater than or equal to 0. So Z is equal to A divided by 1 plus R minus P. This must be greater than or equal to 0, which means that A divided by 1 plus R must be greater than or equal to P. If you combine this upper bound with the lower bound that we constructed in the slide just before, you get that P must be exactly equal to 1 plus R. Should this be a surprise? Not at all. All we are doing is constructing the net present value calculation using a no arbitrage condition. The advantage of doing this net present value calculation using the no arbitrage condition is that it clearly shows what are the assumptions that are needed in order for the net present value to exist. It relied heavily on the ability to borrow and lend at the interest rate R an unlimited amount. If these assumptions are not true, then the net present value is not the correct price, and we would have to use some other techniques to figure out what the correct price would be. The no arbitrage conditions would still be valid, except that we would have to use them with different portfolios perhaps. So what happens if the borrowing and the lending rates are different? I can't use net present value, but I can use no arbitrage. What if the borrowing and lending markets are elastic, which means that if you want to borrow or lend, the interest rate that you're going to be charged depends on the amount that you're borrowing or lending. What happens in that case? Again, the net present value calculation is not valid, but we can construct no arbitrage conditions which would give us, if not the exact price, at least bounds on what such a contract can cost. In this module, we are going to introduce you to interest rates, present values, and how present values are implied by the no arbitrage principles, and also introduce you to the idea of fixed income instruments. An amount A invested for n periods at simple interest rate of R per period is going to be worth A times 1 plus NR at maturity. In every period, you get an interest R times A. So over n periods, you're going to get an interest of n times A times R, and you get back your initial investment, and therefore the total amount is going to be A times 1 plus n times R. An amount A invested for n periods at the compound interest of R per period is going to be worth A times 1 plus R raised to the power n at maturity. And the way to think about it is, what is happening is at time 0, you invest A amount. One period later, this amount A has now become 1 plus R times A. This total amount is now invested for another period. So it becomes A times 1 plus R squared, and so on. So after n periods, it becomes 1 plus R to the power n times A, or A times 1 plus R to the power n. Interest rates are typically quoted on an annual basis, even if the compounding period is less than 1 year. If there are n compounding periods in a year and the interest rate is R per year or per annum, then an amount A invested for Y years is going to yield A times 1 plus R over N. So R over N, this is the interest per period. And the total number of periods in Y years is going to be Y times N. So this is the total number of periods. And the amount that you end up getting is A times 1 plus the interest per period raised to the power the total number of periods. Continuous compounding corresponds to the situation where the length of the compounding period goes to 0. Therefore, an amount A invested for Y years is now going to be worth the number of periods n going to infinity of A times 1 plus R over N raised to the power Yn. And if you take the limit of n going to infinity, that expression solves as A times e raised to the power Ry at maturity. The number of the compounding period is going to 0. Therefore, the number of compounding periods is going to infinity. And you end up getting that the expression simplifies to A times e raised to the power Ry. For those of you who are well versed with differential equations, you can find out that basically what's going to happen is dA dt is going to be R times A. And if you solve this differential equation, you'll get exactly the same expression that we have on that slide. Next, what we want to use is this idea of compounding to calculate present value. Remember, in the last module, we showed how the present value for a very simple bond, which pays $8 in 1 year, you can calculate that using a no arbitrage argument. We are going to do the same thing here using an interest rate R, and then we're going to expand that to the idea of borrowing rates and lending rates being different. So we want to compute the price P for a contract that pays C0, C1, C2, and so on, Cn, at time 0, 1, 2, 3, 4, n, and so on. If Ck is greater than 0, that's a cash inflow. If Ck is less than 0, that's a cash outflow. The present value, assuming an interest rate R per period, can be written as C0 plus C1 divided by 1 plus R, C2 divided by 1 plus R squared, and Cn divided by 1 plus Rn, capital N. In terms of an expression, this is the expression for the present value. We're going to argue that this present value is in fact the fair price or the arbitrage price free. Let me repeat. We are going to argue that this present value is in fact the arbitrage free price P for this contract. Here's the argument. We're going to assume that we can borrow and lend at unlimited amounts at the rate R. And the portfolio that we are going to construct is as follows. We're going to buy the contract. If you buy the contract, what happens? At time t equal to 0, you have to pay an amount minus P, and you receive an amount C0. At time t equal to 1, you receive C1. Time t equal to 2, you receive C2. At time equal to K, some general K, you receive CK. And at time t equal to capital T, you receive CT. I'm going to borrow C1 divided by 1 plus R amount for up to time 1. So at time t equal to 0, this is the amount that comes into my pocket. At time t equal to 1, I have to pay out. I have to return the amount that I borrowed. And how much do I have to return? It's going to be the amount that I borrowed times 1 plus R. And which cancels out the divide by 1 plus R, and you end up getting exactly minus C1. Similarly, I'm going to borrow C2 divided by 1 plus R squared up to time 2. I will get C2 divided by 1 plus R squared into my pocket at time t equal to 0, and I have to pay out an amount C2 at time t equal to 2. Generically, for a general time k, I'm going to borrow Ck divided by 1 plus R to the power k. I receive that amount at time t equal to 0, and then I have to pay out minus Ck at time t equal to k. And what you notice by doing this construction is that the cash flows at all future times cancel out exactly. So the portfolio's cash flows for all time t equal to k equal to 1, 2, 3, up to capital T turns out to be 0. And the weak no arbitrage condition then tells me that the price that I would have had to pay for constructing this portfolio at time t equal to 0 must be greater than equal to 0. all future cash flows are greater than or equal to 0. Therefore, the price at time t equal to 0 must be greater than or equal to 0. What is the price at time t equal to 0? It's the negative of the cash flow. How much did I have to pay? It's the negative of the amount that I received. So the price of the portfolio is going to be minus the summation from k equal to 0 to capital T, ck over 1 plus r to the power k. That must be greater than or equal to 0. That gives me a lower bound, that the price must be greater than or equal to this expression, which is exactly the present value calculation. In order to get an upper bound of the price, I'm going to reverse the portfolio. I'm going to sell the contract. And if I sell the contract, what happens? I receive an amount P at time t equal to 0, but now I'm responsible for the cash flows associated with the contract. I have to be paying the cash flows to the buyer. So I have to pay out C0, I have to pay out C1, C2, all the way up to minus CT. The negative is in front because now instead of receiving these cash flows, I have to pay them out. I'm going to lend an amount C1 divided by 1 plus R up to time 1. So when I lend an amount, money goes away at time t equal to 0, but I get it back at time t equal to 1. I lend an amount C2 divided by 1 plus R squared up to time 2. Similarly, money goes out at time t equal to 0, but it comes back now at time t equal to 2. And how much comes back? It's minus C2 divided by 1 plus R squared times 1 plus R squared, which is exactly C2. Again, if you notice, what we have done here is constructed a portfolio such that its future cash flows are going to be equal to 0, or more weakly, greater than or equal to 0, because everything cancels out. And therefore, the weak arbitrage condition tells me that the price that I paid for this particular portfolio at time t equal to 0 must be greater than or equal to 0. What is the price? It's the negative of the cash flow at time t equal to 0. It's going to be the sum of k equal to 0, 1 through capital T, ck divided by 1 plus r to the power k minus p. And this price of the portfolio must be greater than or equal to 0, which means that the p must be less than or equal to the present value. The two bounds together implies that the arbitrage-free price, the no arbitrage price for a contract, which has a cash flow C0 up through C capital T associated with per period, and in a market where you could borrow or lend unlimited amounts at an interest rate of R per period, is given by the present value. Notice I put a lot of caveats here. I said you could borrow or lend at the rate R. You could borrow unlimited amounts or lend unlimited amounts at the rate R. Both of these are necessary for this price to work out. What if the lending rate is different from the borrowing rate? Now the present value calculation doesn't work, and we have to construct a different arbitrage argument. Here's the arbitrage argument for borrowing and lending rate. So we can lend at the rate RL and borrow at the rate RB. And typically the lending rate is going to be less than the borrowing rate. What is the lending rate for a typical investor? It's the amount of money that the interest rate that you are given for deposits in a bank. And the borrowing rate is the amount of interest that you have to pay for loans taken from the bank. And typically the borrowing rate is going to be strictly larger than the lending rate. So let's construct our portfolio. We had two different portfolios that we had constructed when we did the no arbitrage argument in the previous two slides. One of them gave us the lower bound and the other one gave us the upper bound. The two bounds were the same and therefore you ended up getting an exact price. So let's construct those portfolios. We buy the contract and we borrow ck over 1 plus rb to the power k for k years. Now notice we are borrowing, so the borrowing rate is here. By the same argument that we had in the previous slides, the cash flow in year k is going to be ck coming from the contract minus ck over 1 plus rb to the power k times 1 plus rb to the power k. This is the amount of money that I have to return on the amount that I borrowed. They cancel exactly. Therefore, ck is greater than or equal to 0 for all times in the future. In fact, it's exactly equal to 0. The no arbitrage condition, the weak no arbitrage condition tells me that the price of this portfolio must be greater than or equal to 0. What is the price for this portfolio? It's going to be P, the amount that I paid for the contract, minus C0, minus the summation from k equals 1 through capital N, ck over 1 plus rb to the power k. That must be greater than or equal to 0. This expression here is exactly the present value for the cash flow evaluated at the borrowing rate RB. This portfolio gives me a lower bound on the price, which says that the price must be greater than the present value of the cash flow evaluated at the borrowing rate RB. Now let's flip the portfolio. Sell the contract and lend CK over 1 plus RL to the power K for K years. Notice, because I'm lending, I'm going to have to use the lending rate here, RL, and which RL is less than, typically strictly less than, but at least less than equal to RB. Again, the cash flow associated with this portfolio is going to be exactly equal to 0. In fact, and I'm going to only use the fact that CK is greater than equal to 0. The weak no arbitrage condition now tells me that the price that I should have paid for this portfolio must be greater than equal to 0. What is the price that I paid? It's going to be minus P plus C0 plus K going from 1 through N CK over 1 plus RL to the power K. Why is this the price? Because when I sell the contract, I receive P. When I lend, all of this money goes out of my pocket. Therefore, the net price for the portfolio is going to be the net outflow, which is exactly the quantity that's written out there. That must be greater than equal to 0, and you end up getting an upper bound for the price. That P must be less than equal to the present value of the cash flow C computed using the lending rate RL. This time around, we don't get an exact price for P. We find that the price is upper bounded by the present value calculated at RL. It's lower bounded by the present value calculated at RB. And therefore, we get a no arbitrage interval. This is an example of an incomplete market. Markets where we cannot completely hedge away the risk, and therefore you don't get an exact price using a no arbitrage argument. So how is this price P set? It's set basically by supply and demand, depending upon whether the buyers or the sellers, who has more of a market power, the price would either go to the lower bound or it would go to the upper bound. So the supply and demand sets the price. Next, we want to expand the ideas going from the cash flows to fixed income instruments. Fixed income instruments are securities that guarantee a fixed cash flow. They guarantee you a dollar amount. But are these instruments risk-free? Not at all. There is default risk associated with them, which means that at some point, this entity that is backing these fixed income security might go bankrupt, and therefore the cash flow that you were really promised is not going to come through. About the only entity that is there that is risk-free is the US government or equally stable governments that are going to guarantee you that the cash flow is going to come. Corporate fixed income securities are always open to default risk. Another risk associated with them is the inflation risk. So even if the entity that gave you the fixed income security does not default, the value of the currency might go down over the periods. And as a result, the fixed cash flow is now of lower value. And this happens because the buying power of the currency comes down over time. In order to hedge against this, people have started thinking about TIPS, which are inflation protected securities. Even if there wasn't very heavy inflation risk in the market, there's also a market risk, meaning these securities might become less or more valuable as time goes by. And if you wanted to sell these securities in the market, the price that you might end up getting is going to fluctuate over time. And as a result, you are opening yourself up to market risk. So having said all of that, let's consider some typical fixed income securities and try to price them using a no arbitrage condition. So one of them is the perpetuity, which says that it's going to give you a fixed amount A for all times in the future. What is the no arbitrage price for this security? If you assume that you can borrow or lend at the rate R, an unlimited amount, then the no arbitrage price for this security is going to be the sum of K going from 1 through infinity of A divided by 1 plus R to the power K. If you sum this infinite series, you end up getting that the price is nothing but A divided by R, which is the per period interest rate. Annuity is an instrument. It's a fixed income instrument that pays an amount A for periods K equals 1 through N. You can write this as a difference between two perpetuities. One perpetuity that starts right now, so it pays from, so here's t equal to 0. You have a perpetuity that pays at an amount a at all these times in the future. And another perpetuity that's starting at time n plus 1, meaning here's time n, here's time n plus 1. This is the first time you are going to get a negative amount from this perpetuity. So after that, everything will cancel. So all of these will cancel, and you'll end up getting that the cash flows associated with that is a for t equals 1, 2, up through n. So the difference between these two is exactly the price of the annuity. So therefore, the price of the annuity is a over r. This is the price of a perpetuity that starts right now. The price of the perpetuity that starts at time n is going to be a over r, but this is going to be at time t equal to n. You have to discount this back n period, so this is the discount factor. And when you discount it back, you get the price for the annuity. And this is going to be a over r, 1 minus 1 plus r to the power n. The next fixed income instrument that we are going to be interested in is a bond. A bond is characterized by 5 different parameters or 5 different qualities. There's a face value. Face value is typically 100 or 1,000. There's a coupon rate, alpha, which is paid every 6 months. So every 6 months, a bond pays you alpha times f, which is the face value, divided by 2. There's the maturity. This is the date of the payment of the face value and the last coupon. And there is the price, which is the price at which these bonds are going to be selling. In addition to this, there's also a quality rating. S&P rates them as AAA, AA, BBB, BB, CCC, CC, and so on. The quality essentially is trying to get at the default risk. A high quality bond has very low default risk. The chance that it would stop paying its coupons are going to be very low. A lower quality bond, there's a higher default risk, meaning that there's a higher chance that it would not pay the payments. So here's the story. Every 6 months, so half, 1 year, 1.5, 2, and so on, it pays alpha, which is the coupon rate, times f, which is the face value, divided by 2. And at maturity, capital T, you get the face value back, plus you get alpha f divided by 2, which is the last coupon payment. Now, bonds are going to be characterized by at least 4 numerical quantities: the face value, the coupon rate, the maturity, and the price. And in addition, there is this other quantity called quality. And since bonds differ in so many different dimensions, it's hard to compare bonds. So one quantity that has been introduced in order to be able to compare bonds of different maturities, different coupon rates, and face values is this idea known as the yield to maturity. The yield to maturity is the annual interest rate at which the current price for the bond, P, is exactly equal to the present value of the coupon payments plus the face value. So you take all the coupons and you discount them at the rate lambda over 2, because that's the coupons come every 6 months. Lambda is the annual rate of interest, and therefore you have to discount it by lambda over 2. And similarly, you discount the face value that appears at time capital T, which is to say after 2t 6-month periods at the rate lambda over 2. What this yield to maturity does is that it gives you a single number to start thinking about bonds. It summarizes the face value, coupon, maturity, quality, and so on. It's a number that has understandable movements with respect to quality. Lower quality means lower price, which means higher yield to maturity, which means essentially the intuitively to think about it is that cash payments in the future are going to be discounted with a higher interest rate. Why with a higher interest rate? Because I'm not certain that those cash payments are going to come, and therefore I want to discount them very strongly. With lower quality, I'm even more uncertain, which means that I should have a higher yield to maturity. If the interest rate in the market were to change, then the yield to maturity would change in a similar manner. Yield to maturity, therefore, gives us a way to think about different bonds and compare them. But remember, yield to maturity is a single number. It's a very crude measure. It's trying to summarize 4 different numbers by a single number. So it's not going to be able to capture everything. In this module, we are going to introduce you to floating rate bonds, how to use the no arbitrage principle to price floating rate bonds, and also to the term structure of interest rates. In this module, we are going to price a floating rate bond. This is a bond for which the interest rate or the coupon payment rate that you receive is going to be dependent on the prevailing uncertain interest rate in the market. In order to price this instrument correctly, we have to use this idea called linear pricing. Linear pricing is a theorem or is a result that allows you to combine prices for different cash flows. Here's what this theorem says. Suppose there is no arbitrage in the market, and suppose there are 2 different cash flows, CA, which has a price PA, and a cash flow CB, which has a price PB. Then the arbitrage free price for a cash flow that pays the sum of these 2 cash flows. So C is a cash flow that pays CA plus CB. The price for such a cash flow must exactly be PA plus PB. The prices add up, and this is exactly what is going to be called a linear pricing result. We like this result because now what it allows me to do is to take a complicated cash flow, split them up into simpler cash flows, price each of those simpler cash flows separately, and then using this theorem claim that the price of the total cash flow is just going to be the sum of those prices. I'm going to show you a simple example first, and then I'm going to go towards what happens with floating rate bonds. So let P denote the price of the total cash flow C, which is CA plus CB. And suppose this price P is actually strictly less than PA plus PB. So cash flow C is cheap. The individual cash flows CA and CB are expensive. So how do we do this? We're going to create an arbitrage portfolio. I'm going to create a portfolio that gives you a free lunch. But with no arbitrage, such a portfolio cannot exist, and therefore we are going to get some bounds on the prices. So I'm going to purchase the cheap cash flow C at a price P. And then I'm going to sell the cash flow CA and CB separately. So I'm going to take the cash flow, split it up into cash flow CA and CB, and individually sell them in the market. What is the price of such a construction or such a portfolio? It's going to be P minus PA minus PB, which means it's less than 0, which means that there is a net income at time t equal to 0. The cash flows in the futures exactly cancel out. Therefore, the future cash flows are 0, and I've constructed a free lunch. I've constructed for you a portfolio that somebody pays you to hold at time t equal to 0, and you have no obligations in the future. No arbitrage in the market means there is no free lunch, and therefore the initial assumption that I had that P is less than equal to PA plus PB is going to be false, which means that P must be greater than equal to PA plus PB. We can reverse the argument if P is strictly greater than PA plus PB. What both of these results together show you is that the price P must be exactly equal to PA plus PB. Note that we have to have a liquid market for buying and selling these cash flows in order to have this no arbitrage result give us a bound on the prices. Once we have this no arbitrage result, we are going to see how we can apply that to a very simple example first, and then the floating rate bond next. Suppose that you have a cash flow C, which pays C1, C2, C3 up to C capital T. I want to think of this as a portfolio of capital T different cash flows. So C super T, superscript T, pays CT at time T and 0 everywhere else. So the total cash flow is now a portfolio or a collection of cash flows of a simpler kind. So these cash flows only pay at one time and 0 otherwise. Suppose the cash flows are annual and the annual interest rate is R, then the price of this particular cash flow, which is here's time t equal to 0, here's time t equal to little t, it pays an amount CT here and it pays 0 everywhere else. The price for this cash flow, which we have already computed before, is given by its net present value, which is going to be Ct divided by 1 plus r to the power t. The price of the cash flow C, which is a sum of all these cash flows C super t, is going to be the sum of the prices. It's just the net present value of all the cash flows from the future. We're going to take this simple idea of taking a cash flow, splitting it up into simpler cash flows, pricing the simpler cash flows together, and bringing it back to get the total price for the more complex example of floating rate bonds. So what are floating rate bonds? These are bonds that give you, whose coupon rate is equal to the floating interest rates. What are floating interest rates? Floating refers to the fact that interest rates are random quantities. They fluctuate over time. Let Rk denote the per period interest rate over the period k to k plus 1. This quantity Rk becomes known only at time k. Before time k, this quantity Rk is a random quantity. So if I'm sitting at time t equal to 0 and I have an instrument that depends on this floating rate interest rate Rk, I don't exactly know what the payment is going to be. The payment that I receive on that security will become clear only at the beginning of time k. One period loan issued in period k have to be repaid in period k plus 1 are charged this amount Rk. The cash flow of a floating rate bond is connected to these floating interest rates. The coupon payment at time k is determined by the floating rate at time k minus 1. So it's going to be Rk minus 1 times f. Here we are assuming that the coupons are annual coupons. If it's going to be semi-annual coupons, then it's going to be the semi-annual rate rather than the annual rate Rk minus 1. The face value that you receive at time n is fixed, f. Our goal is to compute the arbitrage-free price, Pf, for the floating rate bond. So what we are going to do is split up these cash flows into simpler cash flows. I'm going to consider a cash flow that pays Rk minus 1 times f at time k. And that's it. It doesn't pay at any other time. I'm going to call that particular cash flow Ck cash flow, and the price of that particular cash flow is going to be denoted by little p sub k. I'm going to have a final cash flow associated with the principal amount at time n, and I'm going to call the price of that particular cash flow as capital P. Capital P is easy to compute. It's just the net present value of the principal capital F paid at time n, which is going to be 1 over 1 plus r to the power n times f. And just to be clear, this r down here is r sub 0, which is the interest rate right now. Using the linear pricing theorem, we know that the price of the floating rate bond, P sub f, is nothing but capital P, which is the price of the principal, plus sum of k going from 1 through n, little p sub k, which are the prices for the instrument that just pays Rk minus 1 at time k. In the rest of the slides, I'm going to try to compute for you what this Pk is. Okay. I'm going to do this in 2 steps. So far, we've only used the no arbitrage argument to price a deterministic cash flow. Here, we are constructing the price of a contract that pays Rk minus 1 f at time k. Rk minus 1 is not known at time t equal to 0. The price has to be computed at t equal to 0. Rk minus 1 is a random quantity. Its exact value or its realization is only known at time k minus 1. So what I'll first do is construct a portfolio whose cash flows are deterministic. All the randomness will be gone. Once I have a deterministic cash flow, I know exactly how to price them. I just have to use the net present value. But net present value using R0, which is the interest rate right now. So here's how I construct the portfolio. I buy the contract, and now I try to look at what is going to happen because of this step. I'm going to have a negative cash flow minus PK at time t equal to 0 because this is the price that I have to pay to buy the contract. At time t equal to k, I receive an amount Rk minus 1 times F. Now this is a random quantity and I need to somehow remove the randomness from the cash flows. I'm going to borrow an alpha amount. This is unknown right now. Over the period 0 to k minus 1. So I end up getting alpha inflow at time t equal to 0 and I have to pay out minus alpha 1 plus R0 to the power k minus 1. And notice the amount that I have to pay out depends on the interest rate at time t equal to 0 because that is where I'm going to borrow. Next, what I'm going to do is I'm going to borrow alpha times 1 plus R0 to the power k minus 1 amount over the period k minus 1 to k. So this is the inflow that happens at time k minus 1. What happens at time k? I have to return an amount that I borrowed. This is just the principal. 1 plus Rk minus 1. This is random. The amount of money that I have to return at time k is going to be exactly known only at time k minus 1. At time t equal to 0, where I'm sitting and pricing this instrument, this Rk minus 1 is not known. Finally, I'm going to lend alpha for the period 0 through k. I get minus alpha here, and I get alpha times 1 plus R0 to the power k there. Since I'm lending, I have a negative cash flow and a positive cash flow at time capital K. Let's now look at what happens to the cash flows at time t equal to k. The net cash flow at that point, Ck, is going to be Rk minus 1 times F, which is the cash flow associated with the contract, minus alpha plus 1 plus R0 to the power k minus 1 times 1 plus Rk minus 1. This is the cash flow associated with borrowing alpha times 1 plus R0 to the power k minus 1 over the period k minus 1 to k, plus alpha times 1 plus R0 to the power k, which is the cash flow associated with lending alpha amounts from 0 through k. Let's rearrange this and take all the terms that correspond to Rk minus 1 and put them all together. You get alpha times 1 plus R0 to the power k minus 1 times a negative sign, and this is coming from this term over here. And you get F from that term over there. This is random because it's multiplying a random quantity Rk minus 1. This quantity here just depends on R0 and therefore it's deterministic. It is known what it's going to be at time t equal to 0. Remember, alpha was unknown. So what I'm going to do is choose my alpha in such a way that this particular bracket cancels out. And if you set that equal to 0, you get alpha equal to 1 over 1 plus R0 to the power k minus 1 times F. This makes sure that the random quantity is equal to 0. Now I want to understand what happens to this cash flow. I have made the cash flow deterministic, and now I'm going to use net present value to calculate what happens to the cash flows. So the cash flows appear only at 3 times: t equal to 0, t equal to k minus 1, t equal to k. What is the cash flow at time t equal to 0? This plus alpha and this minus alpha cancel. The cash flow is minus pk, which is basically the price that you pay for the contract. At time t equal to k minus 1, this quantity and that quantity exactly cancel. And what is the net cash flow that I get at time t equal to k? That's going to be alpha R0 times 1 plus R0 to the power k minus 1, which is F times R0. And how do I end up getting this F times R0? I'm just using the fact that alpha is going to be equal to F divided by 1 plus R0 to the power k minus 1. It exactly cancels out, and you end up getting that Ck is nothing but F times R0. What is the price Pk now? The price of the portfolio is going to be just Ck divided by 1 plus R0 to the power k, which is FR0 divided by 1 plus R0 to the power k. R0 refers to the fact that this is the interest rate at time t equal to 0. Recall that the price of the floating rate bond, PF, is going to be the component that comes from the principal payment, let's call it P, and the sum of all these instruments for k equal to 1 through n. I have just calculated that Pk is going to be F times R0 divided by 1 plus R0 to the power k. I substitute that. I take some terms common. I calculate out the sum of this series going from k equal to 1 through n. cancel out some terms, and lo and behold, the result that you end up getting, that the price of a floating rate bond is exactly equal to the principal or the face value F. The price PF of a floating rate bond is always equal to its face value. That's great. So two things I want you to take away from this little calculation. One of them is the fact that the price of a floating rate bond is exactly equal to its face value. But the second is how we constructed this price. What we did was we pushed our idea of no arbitrage one step further. We used no arbitrage condition to calculate out the price of a deterministic cash flow. Now we push the no arbitrage condition to calculate out what happens to the price of a stochastic cash flow. And we did it in two steps. First, we removed the stochasticity and converted it into a deterministic cash flow. And then we used the no arbitrage condition to calculate the price of this deterministic cash flow. In this slide, we are going to introduce this idea of term structure of interest rates. And it's an idea that will come back again later on in this course. What do I mean by a term structure? What we mean is that the interest rate actually depends on the term or the duration of the loan. So far, we have been assuming that today, the interest rate that you'll be charged for a loan doesn't depend on whether the loan is for 1 period, 2 period, 10 period, 100 periods, whatever. But in reality, that is not true. The interest rate depends on the duration, and it's typically greater as the duration increases. Why does this happen? There are many explanations for it. Investors prefer to have their funds liquid rather than tied up. So if you want to induce them to tie up their funds for a larger period, you have to give them a higher interest rates. There are other explanations, such as people have expectations that in the future rates are going to go up or go down. And therefore, what interest rate that they will be willing to charge for you right now might depend on their future expectation. There's also a market segmentation story, which says that different people in the market are interested in funds at different terms or at different points in time. And therefore, depending upon how the market segments, the interest rates will be different for different periods and would result in a term structure of interest rates. Let ST define the spot rate. This is the rate available today for a loan maturing in T years. So an amount A in T years, its present value is going to be A divided by 1 plus ST raised to the power T. Notice here, this S depends on T. So far, when we were doing the net present value calculation, we would have done A divided by 1 plus R to the power T. Regardless of when the time is coming, the interest rate remains the same. But now you have two things happening. The interest rate changes and the compounding is always there. So it's going to be 1 plus ST raised to the power T. Sometimes it's more convenient to quote the spot rates in terms of the discount rate. The discount rate is nothing but 1 over 1 plus ST to the power T. You can infer spot rates by looking at bond prices. Why? Because the bond prices, at least for default-free, risk-free bonds, are going to be simply a linear combination of the coupon payments discounted at the spot rate. And if you know the prices for bonds for different maturities, you can use these prices to compute out what the spot rates are going to be. Another term associated with the term structure of interest rate is something called a forward rate. A forward rate, FUV, is the interest rate quoted today for lending from year U to year V. If you know all the spot rates, we can compute out what the forward rates are going to be. And the way to use them is to think about two different ways that you can go from year 0 to year V. One possibility is going to be to lend $1 up to time V, in which case this $1 lent for V years at time 0 is going to be worth 1 plus SV to the power V. The other possibility is to lend that dollar for U years and then contract it right away at time t equal to 0 to lend it for another V minus U years. So it's important to remember what we are doing here in the second option is that we are going to lend the dollar for u years, and right at time t equal to 0, I'm going to construct another contract which is going to allow me to lend that dollar at whatever amount of money that I have at time u for another v minus u years. So my initial dollar is going to be worth 1 plus s u to the power u. This entire amount is now going to be lent at the forward rate. So if I lend it, I get 1 plus fuv to the power v minus u at time v. By no arbitrage, these two quantities should be the same, because if one is cheaper than the other, I can make sure that these two, I can make a money without taking on any risk. No arbitrage would violate that condition, and therefore I can argue that these two amounts must be the same by calculating out. Let me repeat. No arbitrage condition tells me that whether I go down the blue path or whether I go up the black path, I should end up with the same amount of dollars, which means that 1 plus sv to the power v must equal 1 plus su to the power u times 1 plus fuv to the power v minus u. Using this expression, you can calculate out what fuv is going to be. It's going to be 1 plus sv to the power v divided by 1 plus su to the power u, the whole thing raised to the power v minus u minus 1. There is another relationship between spot rates and forward rates. 1 plus st to the power t is going to be the product of k going from 0 to t minus 1, 1 plus fk, k plus 1. So 1 periods. And the logic behind that is very simple. You have 0 and v. One possibility is go directly, not v, but t. And here you get 1 plus st to the power t. Or you could hop 1 year at a time. Here is f01, f12, ft minus 1 t. Again, by no arbitrage, whether you go down this path or you go down that path, you should get the same amount of money, which tells me that 1 plus st to the power t must be equal to the product along the above line, which is 1 plus fk, k plus 1, taking the product with k equal to 0 to t minus 1. In this module, we are going to introduce you to the forward contract and also how to use the no arbitrage principle to price forward contracts. A forward contract gives the buyer the right and also the obligation to purchase a specified amount of an asset at a specified time, capital T, at a specified price, capital F, called the forward price, which is set at time t equal to 0. Just to get the mechanics right, here's time t equal to 0. Here's time, the expiration time, capital T. At time t equal to 0, you're specified a price, capital F, which allows you to buy a specified quantity of an asset at that price F, but at time, capital T. So you fix the price at time t equal to 0 for a purchase that happens at a later time, capital T. There's forward contracts there are many examples of forward contracts. Forward contract or delivery of a stock with a maturity of 6 months. Forward contract for sale of gold with a maturity of 1 year. Forward contract to buy $10 million of euros with a maturity of 3 months. Forward contract for a delivery of a 9-month T-bill with a maturity of 3 months. In all of these cases, you are being quoted a price today to purchase the quantity which has been specified in the contract at a later time, capital T. For example, in the forward contract for a delivery of a stock with maturity 6 months, you're being quoted a price today for buying a stock in 6 months. You do not buy the stock right now. You do not. It is a contract price has been set for purchasing that happens 6 months from now. How do you set this price, the forward price, capital F? Here's how it works. Our goal in this set of slides is to set the forward price, capital F, for a forward contract at time t equal to 0 for 1 unit of an asset with asset price st at time t and maturity of capital T. Let little ft denote the price or the value at time little t for a long position in the forward contract. The value of the forward contract at time capital T is known. F little t at time capital T is going to be the price of the asset at time capital T, S sub t. This is the price of the asset minus the forward price. This is the forward price. And why is this exactly the value of the forward contract at time capital T? This is because a long position in the forward, you must purchase the asset at price capital F. You can immediately sell that in the market at a spot price of S capital T, so you make the difference. If the forward price happens to be greater than S capital T, you make a loss. If the forward price happens to be less than S capital T, you make a profit. The forward price capital F is set in such a manner that at time T equal to 0, the value or the price of the forward contract, F sub 0, is exactly equal to 0. So F0, this is the price at time T equal to 0. And that must be set equal to 0, which means that you are indifferent between taking either a long position or buying the contract, or taking a short position or selling the contract. The buyers and sellers are indifferent about taking any position. Just to remind you, little f0 is going to relate to the price or the value of the contract. Capital F would relate to the forward price. This is the price that is set at time T equal to 0, but the purchase is going to happen at time T equal to capital T. We're going to use the no arbitrage principle to set the forward price F. In order to construct this price, I have to get into a concept called short selling. Short selling is the selling of shares in a stock that the seller doesn't own. What happens is that the seller borrows the shares from a broker. The shares come from the brokerage's own inventory. The shares are sold and the proceeds are credited to the seller's account. However, sooner or later, the seller must close the short by buying back the shares. This is also called covering. So you sell the shares in the market by borrowing it from the broker, and then later on you buy back from the market and give it back to the broker. Why would one be interested in short selling? Because one feels that the price of the asset is going to drop. If the price of the asset drops, then you make a profit by short selling. If the price of the asset goes up, then a short sale results in a loss. The short positions can be very risky and have to be handled very carefully. The price can only drop to 0, so the potential profit that you can get from a short position is bounded. But the price can increase to arbitrarily large values, and therefore the potential loss from a short position is unbounded. So if you're taking short positions, one has to be very careful about how you manage those short positions and the risks associated with those short positions. We are going to use short selling as a technique for pricing forwards. Suppose the asset has no intermediate cash flows, for example, dividends or storage costs and so on, and construct the following contract. Construct the following portfolio. You buy the forward contract, short sell the underlying, and lend S0 up to time capital T. And let's look at what are the cash flows associated with this. If you buy the contract, you can get into the contract by paying nothing because F0 is equal to 0. This is how it's constructed. At time capital T, what are the cash flows associated with it? It's equal to the price or the value of the contract at time capital T, which is S capital T minus F. You short sell the asset and buy back at time capital T. What happens? When you short sell the asset, you get S0 into your account because you sold it. You immediately, the funds get credited to your account. You buy it back at capital T, and therefore you have a cash flow minus S capital T happening at time capital T. Notice S0 is the price today. You know exactly what it's going to be. S capital T is a random quantity. It's some quantity that is going to be there in the future. Why did I construct this particular object in my portfolio? I put that because now this ST and that minus ST cancel each other. Remember what we did for the floating rate bonds. We removed the randomness, and that's what we are doing here too. We are removing the randomness. You lend S0 up to time capital T. What happens now? minus S0 is the cash flow at time t equal to 0. S0 divided by D0t is the cash flow at time capital T. This is just a fancy way of writing S0 times 1 plus r to the power capital T, but because now the interest rate could have a term structure associated with it, instead of writing it as 1 plus r to the capital T, I'm just using the discount, and that allows me to give you a more general result which doesn't rely on flat interest rates. What is the net cash flow? I paid nothing for this portfolio. What is the cash flow at time capital T? It's S0 divided by D0t minus F. The portfolio has a diminished cash flow at time capital T and the cost is equal to 0. Therefore, discounted, you should get price of equal to 0. So S0 divided by D0t minus F times D0t, discounted back, you end up getting equal to 0. And therefore, F is nothing but S0 divided by D0t. Now, why is F strictly greater than the stock price? It's because of cost of carry. You are not committing your cash for up to time capital T. The opportunity cost associated with that cash is essentially 1 over D0t. And that's why the F, which is the forward price, which is the price at which you can purchase an asset sometime in the future, is greater than the spot price. Here's an example. A forward contract on a non-dividend paying stock that matures in 6 months. The current stock price is $50. The 6-month interest rate is 4% per annum. Assuming semi-annual compounding. Why semi-annual? Because the maturity is 6 months, so I'm taking sort of the largest period that is associated with the problem. What is the discount rate? It's going to be 1 plus the annual interest rate divided by 2. The discount rate turns out to be 0.9804, and therefore F, which is the forward price, is going to be the spot price, 50 divided by 0.9804, and turns out to be $51. Now what we want to do is construct the value of the forward at some time t strictly greater than 0. Remember, this is the value in the price of a forward contract. We already know that at time t equal to 0, F sub 0 is equal to 0. At time t equal to capital T, F sub t is going to be S capital T minus F, the spot price at the expiration capital T minus the forward price. Now we want to construct F sub little t, which for time t which is not 0 or capital T. And we're going to do this using two different forward contracts. So let F0 denote the forward price at time 0 for delivery at time capital T. So here's what is going to happen. Here's my time t. Here's time 0, here times little t, here time capital T. So F0 is the forward strike price that is negotiated here for delivery at time capital T. Ft is the forward price negotiated at time little t, also for delivery or expiration capital T. Now we're going to again construct a portfolio. We're going to short this contract. I'm going to short the Ft contract. What are the cash flows associated with that? At time t equal to little t, because this contract has been struck at time t equal to little t, I don't have to pay anything to take the short position. At time t equal to capital T, I get F sub little t minus St. Notice this is reversed because I take a short position. I go long on a contract F0. If I had struck this contract at time 0, I would have paid nothing for it because the expiration at time capital T, but the contract was struck at time t equal to 0. However, now I'm buying this contract at time little t. Its value or its fair price is F sub little t, and therefore I have to pay that amount in order to get it. So the cash flow at time little t is going to be minus Ft associated with this contract. The cash flow at time capital T is going to be S capital T minus F0. F0 is the forward price associated with the contract that was written at time 0 for expiration at time capital T. If you take the difference, St cancels, f little t minus f0 is a deterministic quantity, minus ft is a deterministic quantity, and therefore you end up getting that the price, ft, must be just the discounted value of the cash flow in the future, f capital T minus f0 times the discount rate over the window little t to capital T. Let me review what happened here. We're constructing a portfolio using two different forward contracts. The forward contract that I'm calling f sub 0 is a contract that was written at time 0 for delivery at time capital T. If I had gotten into this contract at time t equal to 0, I would not have paid anything. However, in my portfolio, I'm getting into this contract at time little t. And therefore, I have to pay the value or the price of this contract at little t, which is f sub little t. I have another forward contract, which was constructed at time little t for expiration of capital T. For this contract, I know that the value is equal to 0. So I can get into this contract, or I could sell this contract at price t equal to 0, at price equal to 0. The payoff from this contract is going to be something different. It's going to depend on the forward price constructed at time little t. I take both of these into my portfolio, and I do this in order to cancel out the random quantity S capital T, the spot price of the underlying asset on which these forward contracts are written. When you do the net cash flow, you end up getting a deterministic quantity, and I know how to price that. And that's how I end up computing the value of a forward contract at some time t in the future, which is not the time at which it was struck, and it's not the time at which it's expiring.